Hello, and welcome to another segment of Accounting 101. My name is Dr. Annette Moultrie, and let's see what we have in store for you in this video. But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Also, click on the notification bell so you'll be notified of upcoming videos. In this video, we will discuss Chapter 8, Internal Control and Cash. This is Part 1 of Chapter 8, Internal Control and Cash. The learning objectives for Chapter 8 are: 1. Define internal control and describe the components of internal control and control procedures. 2. Apply internal controls to cash receipts. 3. Apply internal controls to cash payments. Learning objective number 4. Explain the internal controls associated with and journalize petty cash transactions. 5. Explain the internal controls associated with and journalize debit and credit card sales. Learning objective 6, demonstrate the use of a bank account as a control device and prepare a bank reconciliation and related journal entries. And finally, objective number 7, use the cash ratio to evaluate business performance. Let us begin with learning objective 8.1. Define internal control and describe the components of internal control and control procedures. So what is internal control and how can it be used to protect a company's assets? Owners set goals. They hire managers to lead the way, and they hire employees to carry out the business plan. Internal control is an organizational plan and all the related measures adopted by an entity to safeguard assets, to encourage employees to follow company policies, promote operational efficiency, and ensure accurate and reliable accounting records. A company must protect its assets. We know that. Otherwise, it is just throwing away its resources. If a company fails to safeguard cash, the most liquid of assets, it will quickly slip away. Now, everyone in an organization needs to work toward the same goals. It is important for a business to identify policies to help meet the company's goals. These policies are also important for the company to ensure that all customers are treated similarly and that results can be measured effectively. Businesses cannot afford to waste resources. Businesses, they work hard. They work hard to make sales, and they do not want to waste any of the benefits. Promoting operational efficiency reduces expense and it increases profits. And 4, we know that accurate, reliable accounting records are essential. Without reliable records, managers cannot tell which part of the business is profitable and which part needs improvement. So here you see there are 4 ways internal control is measured and designed to safeguard assets, encourage employees to follow company policies, 3, promote operational efficiencies, and 4, ensure accurate, reliable accounting records. Internal controls are critical for public companies. The Committee of Sponsoring Associations provides thought leadership related to enterprise risk management, internal control, and fraud deterrence. The committee of sponsoring organization's mission is to develop frameworks and guidance to help companies improve their internal controls and reduce fraud in organizations. Public companies are companies that sell stock to the general public. They are required by the U.S. Congress to maintain a system of internal controls. Congress passed the Sarbanes-Oxley Act, or SOX, to address public concern about various accounting scandals. SOX requires companies to review internal control and take responsibility for the accuracy and completeness of their financial reports. SOX provisions. One is a public company must issue an internal control report, which is a report by management describing its responsibility for and the adequacy of internal controls over financial reporting. An auditor must evaluate internal controls. Two, the Public Company Accounting Oversight Board, or PCAOB, it oversees the work of auditors of public companies. Number three, accounting firms are not allowed to audit a public company. Accounting firms are not allowed to audit a public company and also provide certain consulting services for the same client. Stiff penalties await violators. There could be 25 years in prison for security fraud and 20 years for an executive making false sworn statements. A business can achieve its internal control objectives by addressing the following 5 components that you see here. And you see the acronym CRIME. 5 components. One is control procedures, risk management, information systems, monitoring of controls, and environment. Now, the control procedures are designed to ensure that the business's goals are achieved. As part of the internal control system, the company's business risk, as well as the risk concerning individual accounts, must be assessed. The higher the risk, the more controls a company must put in place to safeguard its assets and accounting records. Controls must be in place within the information system to ensure that only authorized users have access to various parts of the accounting information system. And companies hire auditors to monitor their controls. An internal auditor is an employee of the business who ensures that the company's employees are following company policies and that the company meets all legal requirements and that the operation are running efficiently. An external auditor is an outside accountant, completely independent of the business, who evaluates the controls to ensure that the financial statements are presently fairly in accordance with GAAP. Employees should be competent, reliable, and ethical. Paying good salaries will attract high-quality employees. Employees should also be trained to do the job, and their work should be adequately supervised. In a business with good internal controls, no duty is overlooked. Each employee has certain carefully defined responsibilities. For example, in a large company, the person in charge of signing checks is called the treasurer. The chief accounting officer is called the controller. Even an entry-level bookkeeper whose job includes recording accounting transactions accurately, has clear responsibilities. This assignment of responsibilities creates job accountability, thus ensuring that all important tasks get done. Smart management policies divide responsibilities between two or more people. Separation of duties limits fraud and promotes the accuracy of the accounting records. Now, duties can be divided into two parts. One, separating operations from accounting. Accounting should be completely separate from the operating departments, such as production and sales. Now, what would happen if sales personnel recorded the company's revenue? Well, sales figures could be inflated, and top managers would not know how much the company actually sold. The other separation of duty, separating the custody of assets from accounting. Accountants must not handle cash, and cashiers must not have access to the accounting records. If one employee has both duties, that employee could steal cash and conceal the theft in the accounting records. The treasurer of a company handles cash, and the controller accounts for the cash. Neither person has both responsibilities. This control applies to all assets and not just cash. To assess the adequacy and accuracy of their accounting records, most companies perform both internal and external audits. Remember that an audit is an examination of a company's financial statements and accounting system by a trained accounting professional called an auditor. Internal audits are performed by employees of the company. However, external audits are performed by independent auditors who are not employees of the company. To evaluate the accounting system, auditors must examine the internal controls and test them to ensure the controls are working properly. Now, documents provide the details of business transactions and include invoices and orders, which may be paper or electronic. Documents should be pre-numbered to prevent theft and inefficiency. A gap in the numbered sequence draws attention. Accounting systems are relying less on paper documents and more on electronic documents and digital storage devices. For example, retailers control inventory by attaching an electronic sensor to merchandise. The cashier removes the sensor after a sale is made. Now, if a customer tries to leave the store with that sensor attached, guess what? An alarm sounds. Devices such as these can significantly reduce theft. E-commerce. E-commerce creates its own unique type of risk. Now, hackers may gain access to confidential information such as account numbers and passwords, or even introduce computer viruses such as Trojan or phishing expeditions. One technique for protecting customers' data is encryption. Encryption rearranges plain text messages by a mathematical process. The encrypted message cannot be read by those who do not know the code. Another technique for protecting data is firewalls. Firewalls limit access into a local network so that the members can access the network, but non-members cannot. Usually several firewalls are built into the system. At the point of entry, additional security measures such as passwords, PINs, personal identification numbers, and even signatures are used. For additional security, more sophisticated firewalls are used deeper in the network to protect more sensitive data. The types of other controls are as endless as the types of businesses that employ them. Some examples include fireproof vaults. They store important documents. Burglar alarms, fire alarms, security cameras, loss prevention specialists who train company employees to spot suspicious activity, fidelity bonds to reimburse the company for any losses due to employee theft. Another is mandatory vacations and job rotations. Data analytics and accounting. So here we're going to talk about cryptocurrencies. Did you know that cryptocurrencies have been around for a long time? Cryptocurrencies have been around since 2009, but companies such as Overstock.com and Microsoft are already accepting cryptocurrencies as a form of payment. As of August 2018, an estimated 5% of Americans hold cryptocurrencies, and over 2 million people have used Bitcoin to make payments. Cryptocurrencies work on a blockchain, or list of all of a cryptocurrency's transactions, okay? So cryptocurrencies work on a blockchain, or a list of all of a cryptocurrency's transaction. So the blockchain allows companies and individuals to transfer financial resources across the internet without using a third party, such as a bank, and without sharing company and personal data. Now, any identifying information, such as an individual's name and an address, they're encrypted and they're not shared with the merchant. While transactions are not completely anonymous, because law enforcement can trace transactions to a person or even to a company if illegal activity is suspected. So cryptocurrencies create a pseudo anonymity, okay, that protects individuals and companies' identity and data. Unfortunately, most internal controls can be overcome. We know that. Most internal controls can be overcome. I'm pretty sure you've heard of collusions. What exactly is collusion? Collusion occurs when two or more people work together to circumvent internal controls and defraud a company. It is difficult and it is very costly to plan controls that can prevent collusion. However, the stricter the internal control system, the more it costs. So the question is, how tight should the controls be? Well, internal controls must always be judged in light of their costs versus their benefits. Okay, this is the end of Learning Objective 8.1. Now we're getting to Learning Objective 8.2, apply internal controls to cash receipts. So what are internal control procedures with respect to cash receipts? All cash receipts should be deposited in the bank for safekeeping shortly after the cash is received. Companies receive cash either over the counter, through the mail, or by electronic funds transfer. Now, each source of cash has its own security measures. Consider a retail store. For each transaction, the store issues a receipt to ensure that each sale is recorded. And at the end of the day, a manager proves the cash by comparing the cash in the drawer against the machine's record of cash sales. Now, this step, it helps prevent theft by the clerk. Here you see at Exhibit F8-1, it shows how companies control cash received by mail. Here you see where the payments received through the mail, checks are sent to the treasurer, they're deposited to the bank, remittance advices, you'll see goes to the accounting department, the total amount posted to cash. So they all will end up to the controller, regardless of how it is received. When I say the controller will actually have the financial data, not the money itself, but the data. So let's get into the steps of receiving cash receipts by mail. Step 1, all incoming mail is opened by a mailroom employee. The mailroom then sends all the customers' checks to the treasurer and all the remittance advices to the accounting department. A remittance advice is an optional attachment to a check that tells the business the reason for the payment. In other words, it could be a bill or an invoice. Step 2, the treasurer has the cashier deposit the checks in the bank, and the cashier receives a deposit receipt. Step 3, the accounting department uses the remittance advice to record the journal entries to cash and customers' accounts. And step 4, as a final control, the controller compares the following records for the day: bank deposit amount from the treasurer, a debit to cash from the accounting department. Learning objective 2 continues. Here again with the cash receipt by mail, a lockbox system. Now, most companies use a lockbox system as an alternative to accepting cash or checks via the mail or over the counter. A lockbox system is a system in which customers send their checks to a post office box that belongs to a bank. And a bank employee empties the box daily and records the deposit into the company's bank account. So this is the end of learning objective 2, 8.2. Here we are at learning objective 8.3. Apply internal controls to cash payments. Apply internal controls to cash payments. So what are internal control procedures with respect to cash payments? Companies make many payments by check. Companies need a good separation of duties between the operation of the business and writing checks for cash payments. Payment by check is an important internal control because a check provides a record of the payment. It must be assigned by an authorized official, and the official reviews supporting evidence prior to signing the check for payment. Here you see it, Exhibit 8-2, cash payment by check. It shows the purchasing and payment process. First, you see a purchase order is prepared and sent to the vendor. Second, the inventory is sent by the vendor to the company. However, at the same time, a copy of the invoice is sent to the company. When the inventory is received, it is counted and compared to the original purchase order to ensure that what was received matches what was originally ordered. A copy of the receiving report is then sent to the accounting department where it is matched against the invoice. If the amounts match, the invoice is authorized for payment and a check is sent to the vendor. Here you see Exhibit 8-3. It shows Smart Touch Learning's payment packet of documents, which may be in either electronic or paper format. Each of the documents in the process is prepared in multiple copies. For example, the purchase order has at least 3 copies. One stays in the originating department. 1 copy goes to the vendor. The 3rd copy is sent to the receiving department to be matched against a packing list that comes with the delivered inventory. Only when the system is able to match all 3 documents, the purchase order, the receiving report, and invoice, is the invoice authorized for payment. Now, after payment, the payment packet is marked as paid to prevent the bill from being paid twice. Electronically paid invoices are automatically marked paid by most accounting systems. Streamlined procedures. Evaluated Receipts Settlement, or ERS. Evaluated Receipt Settlement, or ERS. What is it? Well, it is a procedure that compresses the payment approval process into a single step by comparing the receiving report to the purchase order. Electronic Data Interchange, or EDI, Electronic Data Interchange. It is a streamlined process that bypasses paper documents altogether. Computers of customers communicate directly with the computers of suppliers to automate routine business transactions. And this is the end of Learning Objective 8.3. Here we are at 8.4. Explain the internal controls associated with and journalize petty cash transactions. So what are the internal control procedures needed for petty cash, and how are petty cash transactions recorded? Okay, it is not cost effective for a business to write a check for taxi fare or the delivery of a package across town. To meet these needs and to streamline record keeping for small cash transactions, companies keep cash on hand to pay small amounts. And this is what we call petty cash. This fund is called petty cash. Now, petty cash may be used for purchases such as office donuts, cleaning supplies, sympathy cards, entertaining clients, public transactions, public transportations, and tips for service providers. Petty cash controls require the following. 1, a designated custodian. The custodian of the petty cash fund. It designates a small amount of cash to be kept in the petty cash fund. And 3, it supports all petty cash payments with a petty cash ticket. Now, these tickets are sequentially numbered. To set the petty cash fund, a journal entry is prepared that shows a credit to cash and a debit to petty cash. So you're going to credit cash and debit petty cash. A check is written and is cashed at the bank. The cash is then placed in the custody of a responsible employee. And we mentioned what the title, petty cash custodian, who must administer the fund. So here we see on August 1st, Smart Touch Learning creates a petty cash fund of $200. The custodian cashes the $200 check and places the currency in the fund box. So here you see a debit to petty cash and a credit to cash. For each petty cash payment, the custodian prepares a petty cash ticket like the one you see here in 8-4 exhibit. Now, using an impress system is a way to account for petty cash by maintaining a constant balance in the petty cash account. What is a petty impress system? An impress system is a way to account for petty cash by maintaining a constant balance in the petty cash account. At any time, cash plus petty cash tickets must total the amount allocated to the petty cash fund. For example, if you have cash of $100 and you have petty cash tickets, that petty cash ticket must equal the total amount. For example, here we see a petty cash ticket for $60. Say that they have $200, right, for their petty cash fund. So you see a petty cash ticket for $60. So that means $140 should be in cash. So $140 plus the petty cash ticket of $60 is equal to $200, which is the total of the petty cash fund account. On August 31st, the petty cash fund holds $118 in cash and $80 in petty cash tickets. $2 is missing. So here you see the fund balance is $200, cash on hand is $118, petty cash ticket is $80. So the total account accounted for is $198, which is at $118 plus $80. But we started out with $200. So there's $2 that's missing. So to replenish the petty cash fund, you need to bring the cash on the hand up to $200. The company writes a check payable to petty cash for $82. That's the $200 impress balance minus the $118 cash on hand. The fund custodian or the petty cash custodian cashes this check and puts $82 back in the fund box. Now the fund box holds $200 cash as it should. So when cash is missing, the cash short and over account is used to record the unaccounted for amount. The petty cash account is used in a journal entry only when the fund is started or when its amount is increased or decreased. When replenishing the fund, the company debits either the associated expense incurred or the asset purchased with the funds. The sum of cash in the petty cash fund plus tickets may exceed the fund balance. Consider the previous example. Assume that the petty cash ticket number 102 for delivery was for $30 instead of $20. You have a fund balance of $200, cash on hand $118, petty cash ticket $90. Total accounted for is $208, but it should be $200, right? So there's an overage of $8. We know that the total debits are $90. That's the $60 plus the $30. We know the check to replenish the fund was still $82, which is a credit to cash, because the fund balance should total $200. And there was $118 in the petty cash box. So for this situation, we need an $8 credit to make the journal entry balance, a gain which is credited to cash short and over. On September 1st, Smart Touch Learning decides to increase the amount of the petty cash fund from $200 to $300. In order to increase the fund, Smart Touch Learning must write a check for the additional $100, cash the check, and place the additional currency in the petty cash box. So petty cash is debited and cash is credited. Now, had the petty cash fund been decreased, then the debit wouldn't have been to cash and the credit to the petty cash account. Remember that the only time the petty cash account is used in the journal entry is when the account is established, it's increased, or decreased. And this is the end of part 1. So we covered 4 objectives, learning objectives. One was define the internal control and describe the components of internal control and control procedures. We discussed applying the internal control to cash receipts, internal controls to cash payments, and we also discussed how internal control is associated with and journalize petty cash transactions. So in our next video, part 2, we will begin with learning objective 8.5. This is the end of learning objective 1 through 4, part 1 of chapter 8. Thank you for watching. And please, if you haven't already, please click the subscribe button below.